Welcome to Inside Scoop with Sean Emory. Every week we are examining something new, bringing you closer to companies, sectors, and themes. This recording should not be construed as a substitute for personalized individual advice from Avory Company or any guest on the show. This is for educational purposes only and not intended to make an offer or solicitation for any companies or securities mentioned. With that, let's get on with the episode. All right, Ben, Cogan, welcome to Inside Scoop.
Thanks for having me.
Yeah, so I'm glad to have you on here really to talk about, DTC, direct to consumer market. If you don't know Ben, I think, you're in for a treat. Go follow him on LinkedIn, if anything. He posts a lot of pretty interesting content. I think there's really two or three main focuses today that I think, we want to hone in on. Number one, many of these VC-backed DTC, direct to consumer companies have struggled, the ones that have gone public and even those that are not public. Really what went wrong, get it from your lens. This is what you do, and I'll give you a moment to share your background, what you look for in DTC. What do you think drives success here now and into the future, mostly on a sustainable basis. And then three, which is has been interesting to us here at Avory, is where does Amazon stack up in this equation today? Friend or foe? What other channels over the last several years have really propped up that really have a meaningful dent for direct to consumer? You can think of the Walmarts, the social media platforms that are building experiences as well. Before your introduction, I did want to set this stage a little bit. What we've seen over the last 2 years is the direct to consumer market, again, or DTC, where companies really look to build products that they sell directly to consumers. This has been tested, I guess, to say the least. Essentially, what they have to do is handle marketing, shipping, returns. There was this belief for a time period that DTC would totally disrupt the wholesale channels, the marketplaces, bypassing these channels. These brands in theory would have more margin from product sales. The reality is for every Nike, who everyone aspires to be, there's a Smile Direct Club who's burning $100 million, in free cash flow as per your LinkedIn post. These, DTC sounds great. Driving demand to these channels is really expensive. Shipping is tough. The cost to ship went from 2,000 to 20,000 in 6 months, about 2 years ago now. And this totally flipped the economics of these models upside down. Freight rates today, and really as shown in this chart, has gone up, gone down in a meaningful way. And it's opening up, I think, the conversation. And part of the reason why, bringing you on here to learn, what you've seen, what you're seeing. But obviously, this decline in freight rates is naturally, providing potential margin support on a go-forward basis or normalization. So let's turn to you, Ben. Tell us who you are, the amazing stuff that you have built. And, we can go from there.
Awesome. Thanks, Sean. So my background is actually almost exclusively in direct to consumer. I started a venture-backed direct to consumer company called Hubble Contacts, which is still going strong, but left it a couple years ago. Still on the board. We hired in a new CEO who's doing a great job. But left it a couple years ago to start a business called Agora, which is acquiring bootstrapped direct to consumer businesses. So similarly direct to consumer, but businesses that haven't raised any venture capital, unlike Hubble, which did raise a significant amount. And so I've really seen all parts of the direct to consumer universe, everywhere from the sort of incredibly high growth venture backed parts to the slower growth, but potentially more sustainably growing bootstrap part of the market.
Got it. So let's talk about that. So the transformation there from what sounds like, investing in VC-backed based DTC companies prior successfully, to point that in there. And then, today where, you're trying to find the ones that have done it much more organically. Talk about today's DTC market, what went wrong. Just give us a perspective of the last 2 years. I'll start off here with a post from you, which was on LinkedIn. And, there's a lot of negative numbers in here in terms of, return on investment from, let's just say, venture firms or companies, how much they've raised relative to how much they're generating or how much they're worth. I think this sums up a lot of how you feel. But in general, just share a little bit about the last 2 years from your point of view.
Sure. So it's interesting. Direct to consumer, the heyday of direct to consumer e-commerce, I think, really kicked off with Warby Parker, and then there are several other companies similar to Warby, Dollar Shave Club, Harry's, where I actually used to work, which is a great company. Smile Direct Club started around the same time. Casper. I think a lot of these businesses raised a lot. There were some acquisitions like Dollar Shave Club, which is I think in late 2016 sold to Unilever for $1 billion. That I think made investors pretty excited about the market. You had others like Bonobos, which sold to Walmart for I think $310 million a couple years later, which is great. So looks like there were these acquisitions happening that made investors, VCs, excited about the market. And then, of course, what happened in 2020 is the pandemic. So people couldn't buy things in stores anymore effectively, or as much harder to, or more dangerous to. So people bought products online. There was a huge run up in direct to consumer valuations, both because of growth. People thought this would be a new normal, and because, of course, like all of tech, there was a big run up because of low interest rates. And these direct to consumer businesses were fast growing, money losing, but fast growing, which is what people, investors, especially in the public markets, wanted at the time. So a lot of businesses use the opportunity of the open public market window in tech broadly, of course, but also in direct to consumer to go public. Then, things got tough a bit over a year ago. This is again true in the broader tech markets, as you very well know, Sean, but also definitely true in direct to consumer. I think one of the main issues, and I wrote about this in another post actually, is if you look at the market, there is a big bifurcation between tech businesses that have held up well and tech businesses that haven't. And the ones that have held up well generally are the ones that are meaningfully profitable. And unfortunately, most of the venture-backed direct-to-consumer businesses have not gotten to consistent profitability. Really, very few actually have. And the ones that are still trading at pretty decent valuations are the ones that are at least close to profitability or maybe a little profitable. I think the core issue for these venture-backed direct-to-consumer businesses at the end of the day is not getting to consistent profitability, even though that's what the market today is clearly rewarding.
And you think obviously we can look into the models specifically, but part of it is a function of a high cost of sales and marketing. Part of it is a function of an unprofitable product to begin with, and obviously with freights doing what they did, if you had high sales and marketing and you're trying to make money on the product, your gross profit dollar is getting squeezed on the other side. If at the same time, again, there was a lot of demand for some of these channels out there for marketing, so that also rose at that level as well. What are some of the characteristics, I think, from your point of view, that give you the sense of sustainability, whether it's product categories, competition within a specific category, margin structure, and like sales and marketing, as a percent of the revenue,
Yeah.
what kind of some of the main KPIs I think that you look for a business, or just characteristics in general?
Yeah, I think, freight, I think is part of the story, but I don't think is really the main part of the story anymore because as you said in that chart, freight rates have come down a lot from spiking 10x in 2021, and these businesses are still not really getting to profitability. I do think a core issue is the ad costs, as you were mentioning. I think there was an idea here that direct to consumer cuts out the middleman, and that's true in some sense, right? If you're selling online, you're cutting out the middleman of the store, so you don't have to pay the retailer, you don't have to pay Walmart or Target or whatever, but you are paying a different middleman, which is the ad platform. Generally, Facebook for most direct to consumer businesses, but also Google and Pinterest, Snapchat to some extent, but really Facebook and Instagram is the dominant channel. And so direct to consumer didn't really cut out the middleman; it added a different middleman, which is fine, but you know the economics have to work with paying Facebook in many cases 20 to 50% of your revenue, and that could rival what you're paying, Target, Walmart, or any other retailer.
Yeah, for sure. Now, again, so what you're doing at Goro right now, what are some areas that you're focusing on today? What characteristics are you looking for that say, hey, that suggest to you that this truly is sustainable outside of just like pure profits? The profits could be there now, but obviously, there's the belief that obviously prior to like some of these companies prior, which is that we're burning money now to build enough scale to obviously, either wean off the competition, or number two is just scale outside of this. So, unit costs come down, broadly speaking, or you find new channels, I guess, that drive enough revenue outside of what you're doing today, and building like a platform of DTC, I guess, from shoes to socks to shirts, I guess. What are some of the how do you characterize or look for to designate this company is sustainable long term, as opposed to, it's breaking even today, or profitable today, but not necessarily, a category that will survive the test of time.
Yeah, I personally think it's pretty difficult to predict which categories are going to succeed. I mean, even if you look at the categories a couple years ago that were, or a year ago during the pandemic, that were doing really well, most of those have really fallen back down to earth. You know, a lot of outdoor products, automotive products, like effectively products that people were buying because of the pandemic, have really not done well in the last couple of years. And so, um, we have some views about category, but it's really difficult, I think, to predict in advance what's going to succeed. I do think the best the best thing we have to predict whether a business is going to continue to grow and be profitable is just its history of profitability. Um, in general, the businesses we've seen which have done the best in our portfolio have been the businesses that have had a significant measure of profitability and have good fundamental core unit economics, especially LTV to CAC ratio. And so there are businesses that may have strong gross margins, but if you're spending 50% of your of your revenue on marketing, that makes it really hard. If you're a business though that has a strong brand, has a lot of organic sales, you can keep your CAC down for that reason, and you have strong unit economics that can compound over time really nicely. I think it's not always easy to predict if it will continue, but I think category agnostically, um, rather than looking at businesses that were growing market share and growing revenue by investing in growth, we really look at businesses that have a consistent history of profitability. And that to us, at least historically, has been the most predictive of future profit growth.
Right. Got it. Yeah, no. So I mean, it's somewhat fascinating, right? Because obviously during COVID, you saw a boom in some different categories, specifically, the home and outdoor, anything that was around your house for sure. Um, Now, a lot of investors or people extrapolated that growth out into the future, kind of in a linear fashion. Um, Now, there's a lot of people today that those categories have rolled over, and the same is happening potentially on the other side, which is you're extrapolating that to the downside. And how we like to think about it is around frequency, which is the frequency of that purchase, like a Peloton or something, where the renewal cycle, the refresh cycle of these things are elongated naturally. Pre-COVID, post-COVID, it doesn't really matter in terms of your the period of refreshing whatever you have, a grill like Weber, or
Yeah.
some of the others. um and at some point there's going to be a refresh cycle, and the leaders in those categories are likely, if they're still around, are going to be the beneficiaries, you should assume, that refresh cycle again, whether it's like a Peloton or even just cars, anything extended in terms of that refresh cycle. How are you thinking about that, from a investment perspective, of like, there's the curve, the bell curve of demand surging to demand falling off a cliff, to there's going to be a normalization of this demand back to, or is this going to be kind of like higher highs and lower lows, because we had such a concentrated purchase environment, that the refresh cycles are just going to be giant tidal waves. That's how we're thinking about like direct to consumer, or just goods in general. And whether it's the wholesale channel or direct to consumer, what's your mindset around that concept?
Yeah, look, that makes a lot of sense to me. I like that thesis. In general, we're not looking at category. We're definitely looking at category a lot. It's not exclusively what we're looking at. We think within any particular category, there are businesses that could be winners based on their core unit economics and CAC to LTV ratios. Um, I do think there are certain types of businesses that just are more likely to succeed on Facebook and Instagram. 2022, as you know, Facebook took a huge hit due to iOS 14, and people were really wondering whether Facebook would ever really be the engine that it was in the past. 2023, Facebook has made a lot of improvements in their algorithm. Their AI tools seem to actually really have been working to their credit, and Facebook cost per acquisitions have come down pretty significantly, and CPMs as well in the last few months, which is pretty exciting for the direct to consumer space. That being said, there's some businesses and some products that I think inherently have really tough time working on Facebook. So Facebook, unlike Google, is an auction of all products. Like if you have a product, you're bidding. If you're advertising on Facebook, you're bidding against every other product that's advertising on Facebook. And so, unless you have particularly high AOVs or really high LTVs due to significant amount of repeat, it's really hard to make it work. So, if you have a product that's relatively inexpensive and people don't buy that frequently, so the LTVs are low, you're still competing with mattress companies that sell for $1,000 plus on Facebook, and so can afford to spend a lot more to acquire a customer. So it's going to be really hard to make it work. In general, we look at Facebook. We look for Facebook products that are either pretty high AOV, even if they're one-off purchases, or maybe relatively low AOV, but pretty consistent. Like contact lenses is another example from Hubble. So yeah, it's really hard to know. Generally, we look at the data. I think it's really hard to predict categories, but those are some of the rough rules of thumb we use to predict what's going to work in the future.
Got it. And AOV being average order value for those listening. The interesting little parallel here is or question is around the social media landscape. It kind of goes down to the third point, which is what platforms are you looking at, different channels. There's the physical brick and mortar channels. Obviously, that's not direct to consumer, but in the role of retail, it plays a critical large role still. And we saw that, even in the face of, a time where everything went online, you still had, people migrate back to old habits, or you don't have to call it habits, just what they want to do. And, so those channels still exist. And then you have some of the marketplaces that exist, whether it's, the Amazon's, Wayfair's, some of the other channels as well, Walmart's platform. Talk about, if you could, any of those channels, and then social media. I mean, we could maybe split the two, the
Sure.
marketplaces relative to social and the potential of, having actual sales directed on those social platforms as they can try to build out those tools for sellers to sell. So, yeah.
Yeah, I think there's been a big shift in direct to consumer brands mindsets about these other channels. Maybe a few years ago, people were really averse to Amazon and retail. That aversion has totally, maybe not totally, but largely gone away. I think people know that to expand beyond a certain scale, it is really difficult to do that on your own website alone. And so most brands that I talk to are, if they can, expanding into Amazon and retail. And it's harder than direct to consumer in a lot of ways, but it's more sustainable. It's still the case that more than 80% of retail purchases are made offline, maybe 75%, but something along those lines. So if you want to go where your customers are, especially for certain types of products that people like to try or try on before they buy, being in retail makes a lot of sense. There's been a big shift from thinking about direct to consumer as a business model on its own to effectively, which makes sense, being a channel, which you can have work, you can use to test new ideas, test pricing, test creative, test products. But really, at the end of the day, you can build a nice, profitable, relatively small business on direct to consumer. But if you're going to build a large business, most people think now have to be omnichannel.
Got it. And talk about Amazon, the relationship there. Obviously, we've always had the belief that, when you succeed on Amazon at scale, in a sense, in terms of whether it's one product or, multiple products, there is kind of this competitive advantage that you do build over time based on reviews, rankings, and
Sure.
and just engagement. Keyword searches, a lot of that is now paid for. But in general, talk about that, which is, is there a competitive advantage to be a leader? How sustainable do you think that is? And how easy is it to take, one of your brands that is, maybe crushes it in, DTC, Instagram, and, you get a lot of viral adoption there versus, taking that and putting it on Amazon and maybe not just getting to the same success, which may answer, the first question here, which is how competitive, if you're already there, in general, like that kind of conversation.
Yeah, Amazon is pretty competitive. Sort of like almost the sort of classic econ 101 definition of perfect competition. You have the exact same products in a category listed next to each other with their prices and reviews listed out. Um, that being said, I think Amazon is a really powerful channel. And for basically all the direct to consumer businesses that we're acquiring, we're at least exploring launching them on Amazon and have launched them on Amazon if they're not there in many cases. I think that's true for a lot of reasons. One, the big question for direct to consumer businesses with Amazon was, are you cannibalizing your direct to consumer sales, right? So if you have a direct to consumer business, people are searching for you, maybe they see you on Facebook or Google or even a TV ad, and they're searching for you and they buy you on Amazon, you're paying Amazon a significant fee or tax that you wouldn't otherwise pay if they were buying directly from your site. Plus, you don't have the data from that acquisition, so you can't remarket to those customers as easily. I think that was the main fear. Amazon would both tax you on the purchase and also, you know, effectively be able to compete with you by having all the data of who your customers are, which would allow them to launch new products in your category and things like that. I think those fears are still around for a lot of folks, including us. But at the end of the day, so many sales from so many people happen on Amazon that you have to go where your customers are. And there are a lot of people who see a new product, don't necessarily trust that the direct to consumer site is going to ship them the product or be honest with them, or give them their money back if they don't like it. Amazon has over decades built trust with consumers that they are a product or they are a platform that will be there for you in case something goes wrong, and has built a lot of brand equity with consumers. And so a lot of folks I know will, or a lot of consumers, it appears, will much prefer to buy on Amazon. And so, you have to go ultimately, I think, where your customers are. Um, Amazon has, it has issues. They're not always that responsive to sellers sometimes. Their fees have gone up a lot in the last few years, especially with the implied fees from the fact that you really have to advertise on Amazon now, even if you want to have significant or better placement for your organic listings. Amazon cares about how much you're spending on the paid ads on the platform. Those are all issues, but you can make Amazon businesses work profitably. And if you have brand equity that you've built up on the direct to consumer side, it is often much easier to launch a product or launch that brand on Amazon, versus a de novo product that has no direct to consumer presence at all.
Got it. Cool. Last little, segment is one around social. Like, are you excited? Are you preparing for, the potential wave of actually, purchase, the concept of Instagram and some of these channels being these digital malls where there's, experience happening on the platform, great visuals and kind of user or interface of, some of the different products that exist in the ecosystem. Obviously easy marketing and or advertising that brands are already accustomed to. It's just obviously just going end to end and then building that trust as well on the platform is critical. So your thoughts, are you guys preparing for it? And excitement around it. What platforms would you probably prefer to see if you had to wave a wand and say TikTok, get it all together, and we can do it here, or Instagram, or I know it's not Twitter, but
Yeah, probably not Twitter. Yeah, I think if anyone's going to do this successfully, it's Instagram. Instagram has launched tools in the last few years to try to make moves towards this direction, sort of like one-click checkout, allow you to buy on the platform directly. This was a bigger thing even like 2018, 2019, if I remember correctly. It hasn't really taken off that well. I think part of the reason is when people are buying a product, even direct to consumer, there's some smaller purchases that they'll make on the platform directly, but larger purchases, people usually want to go to the site, they want to read the reviews, maybe they'll go off the site and Google the product to see if they can find reviews. They'll think about the purchase for a while, maybe they won't buy in the first touch. So yeah, I do think Instagram has improved their sort of Instagram shopping tools so that you can buy directly from the platform without going to the site. But I haven't seen it sort of take over commerce like I thought it might have a couple years ago. Maybe TikTok will make moves here. TikTok's platform in terms of user engagement and viewers is much more advanced than their platform for advertisers. Uh, Many people I know have, including us, are able to get Facebook and Instagram to work, and are not really yet able to get TikTok to work as an ad platform. So I think getting it to work there first before they make moves to allow you to buy from TikTok directly probably makes sense. But I mean, they're the only other option besides Facebook and Instagram that I think could potentially be really disruptive here.
cool. Yeah, let's summarize with Agora, which is just today in this environment right now. What excites you in the space?
I think the silver lining of the fact that so many of the venture-backed direct-to-consumer businesses have done relatively poorly in the markets in the last couple of years is there is a renewed focus on profitability, core unit economics, cash flow, and that is just very consistent with how we at Agora think about what makes for a great direct-to-consumer business and business more broadly, honestly. look, if you have certain types of products, they should lose money. Like marketplaces, they take a long time to build up. You could have other types of platforms that have large fixed costs that you need to invest in upfront in order to make money in the long run. Great. Like those businesses should burn potentially significant amount, like billions of dollars in some cases to get to scale. We think direct to consumer businesses are different, and the best direct to consumer businesses get to profitability quickly, very quickly. And um, the silver lining of what's happened in the market in the last couple of years is we think others now, many more folks are agreeing with that approach.
Got it. Cool. We always have, quite a bit of listeners, viewers that have started historically, have started. We've been asked in the past, if you had to give, you know, not necessarily advice, but some of the businesses you're looking for, just to give an outlet, what you're looking for, how people can find you, and anything else you want to share, before we hop off.
Sure. Yeah, our website is Hey Agora, Hey Agora.com. So if you have a great direct consumer business that you're looking to sell one day, or even not not yet, but you're looking to sort of chat with us, happy to just come to our site and put in your brand or and your email, and we'd love to chat with you. Um, yeah, look, I would say to the extent that it's advice, it's it's kind of trite, but if you can build a great business from day one, which is cash flow positive, without external capital or with limited external capital, I basically encourage everyone I know to be able who can do that to do so. It's harder. It's not what I did a few years ago with Hubble. Um, so, I definitely see the appeal of raising, and in many cases I actually do think it's fine to raise some amount of capital. But when you get to these brands that are raising hundreds of millions of dollars in order to scale, I think those days are largely over, at least for now. And so, building a profitable cash flowing business from day one, is I think going to be best for most brands.
Cool. Well, Ben Cogan, appreciate you coming on Inside Scoop, sharing all the details around direct to consumer, the marketplaces, and all the nuances around it. Again, everyone, if you want to find them, hey Agora, learn more, reach out to us if anything. If you want to come to us, and we'll put you guys in touch. Regardless, thanks for coming on, and appreciate the conversation.
Thanks, John.